Money FM 89.3. Best of breakfast. The bigger picture, only on Money FM 89.3.
Good morning. Welcome to The Bigger Picture. And we are looking at the Singapore economy with the latest numbers out for its third quarter GDP. The advanced estimates have it that it grew 2.9% year on year. So that surpasses expectations, but it is still a moderation from the previous quarter's pace. And in line with that, the Monetary Authority of Singapore has opted to maintain its current monetary policy stance in October, so no changes. So let's check in now with Selena Ling. She is the Chief Economist for OCBC Bank. Good morning, Selena. How are you doing today?
Good morning. Good. Thanks for having me.
All right. I am glad to have you on because we've got a couple of things to unpack. Let's start with the third quarter GDP numbers. So your forecast was for 2.1%. So I guess it's good news. We've got a beat there, 2.9%.
Yes, definitely. So, third quarter growth has actually again surprised on the upside. Now we're looking at the first three quarters coming in at 3.9%. That definitely warrants an upgrade to the full year growth forecast. So we're looking at probably about a handle of 3% growth for 2025, which is actually quite remarkable given that we've had, tariffs, we've had geopolitical concerns.
Yeah, where is this surprise upside coming from? Which are the brighter spots?
Well, the bright spots really, what we are seeing is that construction and services have remained relatively resilient. A lot of it is due to, of course, ongoing infrastructure investments and, of course, the easing financial conditions as, interest rates head lower. So financial services get a bit of a bump. But I think what also surprised was that, manufacturing has actually done quite well in the first half of this year. And although we were expecting manufacturing to see a modest contraction in the third quarter numbers with the implementation, of the reciprocal tariffs, actually they managed to flatline rather than contract. So that was a bit of a surprise.
Yeah, so we are all expecting a lot of front-loading of sorts and then moderation to come. So to some degree, it has played out to that script. What are we expecting or looking out for in the coming quarters as we see, continued tensions with US-China trade talks, all the monetary policy moves by the Fed as well? What are some of the global risks that will affect Singapore's economy in the coming quarters?
Well, I think the main risk would still be, what's happening in the external landscape, which is one where there may be some product-specific tariffs that may be coming, particularly for, key industries like semiconductors and pharmaceuticals. Although the silver lining really is that, it looks like the U.S. administration is open to some company-level type of negotiations if they, onshore some of the production or investments in the U.S., so maybe we just have to wait and see on that front. But I think, the geopolitical landscape also remains a little bit challenging. I mean, we've had this re-escalation, for instance, of U.S.-China tensions over the weekend. So things are still fairly choppy. But I think generally market sentiments have improved since April because reciprocal tariff levels have come down. And I think we see that in the purchasing managers' indices as well.
Yeah, what are you seeing when it comes to some of the trends playing out in the local economy? Because some headlines have been going around, job cuts, closures of some big brands as well. What are you seeing when it comes to consumer spending and also property market in terms of steering the outlook for the Singapore economy?
Well, generally, the labour market, while hiring intentions have slowed a little bit, I think in particular for fresh graduates, actually the overall unemployment rate still remains very low. So I think from that sense, household balance sheets are not very dented. In fact, they are benefiting from some of the wealth spillover effects from, the booming asset markets, like equities, etc. So private consumption, we think, will remain quite steady. But you are right in the sense that, for the local SMEs, they are under some challenges as well because we have seen an influx of competition. And they are still grappling with slightly sluggish demand and high cost structures. So I think there's no getting away from the fact that there's still a fair bit of churn that will happen in the corporate sector from here.
All right, talking about high cost structures, how should we be thinking about inflation in the coming months? We've seen the MAS monetary policy statement, no changes. This year, we've seen them, I think, ease twice. What are we looking out for when it comes to the strength of the Singapore dollar and what to look out for when it comes to inflation?
Well, inflation is very interesting because if you look at the July and August numbers, actually they are very subdued. Core inflation in particular, I think reflecting some of the government subsidies for long-term care, plus the fact that, domestic cost pressures and also imported costs for like energy, for instance, are coming off. So actually, we're kind of like in this period where we're enjoying low core inflation. But of course, the risk is we don't know, in the days ahead, will the geopolitical tensions re-exert on the supply chain side? But generally, I think if you look at the MAS rhetoric, they basically do expect that core inflation should continue to remain very subdued in the near term, but pick up only gradually into 2026. So I think they are very comfortable as to where monetary policy settings are currently. So growth is surprising on the upside, but core inflation remains very low. And although it may edge up into 2026, is still, within the 0.5 to 1.5% kind of range. So there's no urgency to move from here.
No urgency. And for some color, the US dollar versus Sing dollar, we are looking at the Sing dollar gaining ground against the greenback by nearly 5% year to date. Now, talking about rhetoric, what sort of tone or message are you getting from the commentary, or at least the statements out from the MES and the MTI this morning? Is it one of optimism, more optimism, I suppose?
Actually, I think it's very neutral. I think they are basically saying that, this above-trend growth that we have seen in the first 3 quarters will not last. The slowdown will come because a lot of that front-loading would ease. But the mitigating factor to that is actually that, supply chains have been quite resilient to tariffs. And we are still seeing this AI investment boom that's ongoing. So that's giving a little bit of a lift. And then on the domestic side, basically we've had this story where private consumption is relatively healthy. And labor market, while softening, is not in a dire position yet. So I think net, generally it seems like we're okay for now. Hence, it'll be interesting to watch because after the monetary policy meeting today, the next meeting is in January, but will be closely followed up with the Singapore budget as well after that.
Yes.
So, so much monetary policy from here, but maybe decide what will happen.
Well, plenty to watch out for. And helping us out this morning to unpack the third quarter GDP numbers, where Singapore's economy grew 2.9%, beating expectations. We've been in conversation with Selena Ling. She is the chief economist for OCBC Bank. Selena, thank you so much for your time and insights.
Thank you.
All right, catch up with you again soon. Stay Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.
Money FM 89.3.